For more on where the markets go this morning, though, we're joined this morning by Bill Nygren, portfolio manager at Oakmark Funds. Bill, really a pleasure, as always, to talk to you, but especially to round out the year. Good to see you again.
Thanks for having me.
Your general view of 26, and what kind of grade would you give 25?
Well, I think first, 25 was a great year. Tough year for active managers to keep up, especially if you weren't heavily weighted in the growth stocks that really led the market. And the other big issue for 2025 was just how strong a factor momentum was. I think in the past 2 years, momentum's been almost as strong as it was back in 98 and 99 in the dot-com-led market, where all you had to do was look backwards and just buy the stocks that had been performing the best, and they continued to outperform. That's really unusual for that to last more than a couple years. So our belief and hope, because it would benefit how we invest, is that the names that have been left behind are kind of catching up in 26.
Yeah, I was looking at a Barron's piece this morning on Salesforce. The headline is "Ready to Emerge as an AI Winner," and they quote you, where you say maybe 8 to 10 times sales for a software company is not too crazy.
Well, that's certainly the price, the ballpark price you get to in the acquisition market, and Salesforce is much more dominant than the companies that are getting acquired at 8 to 10 times. And even Morningstar now classifies Salesforce not as a growth stock. So it's been left behind enough that value investors like us have to take a look at it.
Are financials still valuable? You hold a lot in your portfolio, but you do say that you hold less than you did before, given the run, I assume.
Right. At Oakmark, one of the things we almost always do is trim into strength. We don't want a strong market to be increasing the weightings that we thought were appropriate. So we went into the year with financials by far our most heavily invested industry. The theory was, like, if we just take banks as an example, they were selling at small premiums to book value. We think they're better businesses than electric utilities, and the electric utilities are selling at twice book. As they've closed that gap, they aren't quite as attractive as we thought they were at the first of the year. But when you look at low teens multiples and how much the risk levels have been reduced in those businesses, I think that's still pretty attractive compared to mid-20s for the S&P multiple.